Much. And last but certainly not least, we have Mr. Ishmael Nwokocha, General Manager, Corporate Treasury at MTN Nigeria Communications. I think I did see him earlier. Is he coming? Oh, yes. My apologies. How could I? Also joining this panel, my friend and the president of the Financial Markets Dealers Association, FMDA, and head fixed income, currencies, and treasury at FBN Quest Merchant Bank. Please welcome Mrs. Adetun Dosumo. Can we put our hands together for all of them, please? Thank you very much. All right, so Zil, over to you. Can we have all the microphones on stage, please? Thank you.
Okay, great. I think it's working now. Okay. Good afternoon, everybody. And this is hopefully going to be a very interesting panel. I know I have all the right people on the panel, people I've known for a very long time. Now, in discussing derivatives, we've found that generally there is the most recent memory of derivatives is the global financial crisis of 2009. And many people don't realize that derivatives have existed from, when I did my research, I came across the first derivative transaction about 8,000 years before Christ was born. I was surprised. It was the first oil trader, something of Miletus, if I remember correctly. I think a Greek oil trader. It was olive oil, by the way, not crude oil. And he was an astrologer and a philosopher. And based on what he saw in the stars, he realized that that year was going to be a bad year regarding harvest, but that the following year was going to be a great year. And so what he did, he went to all the farms that harvested olives, because that year the produce was really, really bad. And so he offered them the current price of olives at that time and said, okay, you know what? Since you had a bad year, you can't sell your olives. Let's agree that I will fund you at the current price now and pay you now, and you give me the rights to all of your harvest next year. Now, for farmers who had just had a horrible year, they all agreed. And so he paid all of them and bought the rights to buy all their olives the following year at the current prices that were really bad. This was 8,000 years before Christ was born. Now, those of us in derivatives know exactly what he did. He just bought a call option. So when we speak derivatives, it's nothing new. It's been around for a very long time. And so hopefully what we're going to show today is that as an economy, we're quite behind the curve in deepening our financial markets. We have a very large financial market, but it's not very deep. We've hit near rock bottom regarding our digging, and once we break that barrier, the very next stage we're going into is derivatives. So today we're hopefully going to discuss the basics that we need to put in place and all the hindrances so that when we leave here, we can begin to execute the things that are needed to get the market going. So I will start with Mr. North because Tom is a grandma in this industry, David is a grandpa in this industry, and Ishmael is a great-grandpa. So, and all of us will be suffering from the toad in boiling water syndrome. We've adjusted so much to a lot of things that we may not see it. But Paul, fresh eyes, fresh mind, fresh concept. So, based on your experience in Nigeria so far, what do you think regarding education and the infrastructure for derivatives?
Thank you very much, Zil. Good afternoon, ladies and gentlemen. It's a great pleasure to be here today in your company. I have, in fact, been to Nigeria on 4 or 5 other occasions now at the request of FMDQ. 25 years ago, I met Coco in London. I was delivering a derivatives presentation. I used to work for the London International Financial Futures and Options Exchange. And I remember him saying to me that one day he's going to bring listed derivatives to Nigeria. And of course, I thought, yes, okay, fair enough. And here I am, 25 years later. And at the time, of course, when I first started working in derivatives in London back in 1988, it was still a new market. You have heard that derivatives have been around for well over 4,000 years, but financial derivatives are still relatively new. They really emerged on the scene back in the 1970s. So it was shortly after that that financial derivatives in London started. And when I think back to my time in London, one of my early jobs in business development of the exchange was to go out and speak to various participants about financial derivatives. And there was a lot of skepticism at the time about them, believe me. I would speak to pension fund communities, corporate treasurers, and there was this apprehension about using derivatives. In part, it was to do with the fact that the people who were in position to make decisions about whether the organization should embrace derivatives had not necessarily used them themselves. So there was a certain amount of trepidation. And to answer your question, how do I see parallels in Nigeria? It's a very similar thing. For a lot of people, it's still taking time to develop their knowledge and bring up to speed their understanding of derivatives. But I mentioned that I've been to Nigeria on 5 occasions now, and I am very, very impressed with people's desire to develop their knowledge and also their understanding as well. Please don't get me wrong. It's not like I'm suggesting that people in Nigeria don't have that knowledge. They do, of course. But it's maybe at certain levels where that knowledge is. And, of course, for the market to really develop further, and, of course, I would say this coming from an educational background, it's important that all the different layers within an organization get to understand how derivatives work. The earlier sessions this morning, I was listening with a lot of interest with respect to the CCPs. Of course, they're so pivotal and important in the whole, the whole makeup of the market, and understanding how the CCP instills that sort of discipline upon the clearing members when it comes to the margining side. That then filters through to the organizations, the various participants, and ultimately the very end users. So, as I say, I'm pretty impressed with the education so far, but of course, in Nigeria, it can...
Okay, another question, Paul. In your opinion, would you say the development seeps down faster coming from the corporates or from the financial institutions?
So, if I understand your question, I'll send at corporate level.
Yes, so if we wanted the derivatives market to develop faster, would that education be more concentrated in the corporate sector or in the financial sector?
Sure. So when again, if I can just draw some parallels back to the United Kingdom, where I first got involved in the market, banks were a little bit ahead of the curve in terms of their understanding of derivatives, understandably. And the exchange would work in cooperation with the banks and the brokers to go out to their institutional clients and cooperate on various workshops and seminars. And it took a while, really, for the sort of corporate sector and the sort of fund management side to embrace derivatives. And although, of course, they tend to be clients of the banks, they're sometimes a little bit apprehensive about what is it the bank wants to sell them. So they're a little bit cautious about it. So one of the things that worked very well from the Derivatives Exchange in London was that we held special presentations for the corporates and the pension funds as well. And we were able to speak to the corporate treasurers and the fund managers. And then once they were sort of happy with their understanding of derivatives, in order for them to embrace derivatives, they had to have proper risk management controls in place. So that would mean bringing up their staff. So again, we would then reach out to the different layers within the organizations and try to tailor the presentations to meet their specific needs.
Okay. I promise I'm not asking the questions because of how they are seated, but Tom, I think you just dropped the ball on your lap. What is regarding education and dissemination of information and stakeholder engagement, stakeholder being regulator, clients, legislators. What role is the FMDA playing in deepening the derivative market?
Okay, first and foremost, I want to use this opportunity to to expatiate or differentiate between FMDA and FMDQ. I get asked that a lot. I will use a racing analogy. So the Nigerian financial market is the F1. FMDQ is Mercedes-Benz, and FMDA is Lewis Hamilton. So basically, FMDQ, they provide the structure, FMDA provides the people and the race drivers. So in saying that, we are in charge of developing and training the market, providing advocacy between the market and the regulation. And how we're going about doing that is we organize on a quarterly basis training, free training for the markets. That's one of the advantages you have as a member of FMDA. And we invite the regulator because, like he said, the pushback really is from people because people don't understand what derivatives are, so they push back. And I always say it's difficult to trade. You find it very difficult for the regulator to accede to your request of trading a particular product that they don't understand. So all the trainings that we do for the market, we ensure that the regulators are invited to train so that they can have a basic understanding of what we're talking about, because it's difficult for them to regulate what they don't understand. And we also try and explain to them the advantages of having a vibrant derivatives market in Nigeria. To an extent, they are more open, especially with the success of the non-deliverable forwards. So they see the advantages, saw how it increased trading in the FX market. So it's now a question of shifting it to other asset classes.
Okay. Now, I think I have the easiest job here. I just have to sit here and ask everybody questions. From what you've said, I'm aware that there is significant mileage that has been made regarding the legislation around the netting law. But the other thing is regarding the market infrastructure. And in my opinion, I think the market for derivatives to begin to be traded or to start making reasonable headway, there needs to be a two-way interest rate market. Yeah. Like we have a two-way foreign exchange market. We don't do commodities, so but at least interest rates and foreign exchange, we have a two-way, fantastic. The rules are there, the regulations are there. Why is it that we do not yet have a two-way interest rate market?
I asked you not to ask this question, but anyway. So it's a question of, right now, the market, just a few, it's only on a bilateral basis that banks trade amongst themselves on a clean basis. The huge portion of volumes of trades on the market are fully on OBB, secured. So for you to have an interest rate market, you need to be able to trade clean amongst yourself. So there's been pushback amongst the market and amongst the regulators on the need for the market to start trading clean. We are working, it's a work in progress, let me put it that way. And it's something that we are aware as a market that we need to do, and we're working towards it. We're engaging, we are using moral suasion, we are doing everything we possibly can because we understand we understand the need for an interest rate market to take off.
So why hasn't it?
Because banks, there's still some pushbacks from some banks. Because, like I said, if you don't have a clean line for me, I can't trade. And because the money market is really short. It's just overnight, on an overnight basis. It's just a few banks that do bilateral and they do a longer tenor. Okay. But there's a resistance because the market has been comfortable trading OBB for too long.
Do you think there will be good enough mileage or some significant mileage if the regulator gets involved more aggressively?
I think so, because I remember earlier on this year...
Which regulator now?
The CBN.
Okay.
I remember when about 4 or 5 months ago when they actually called the market to say, okay, why are you not trading clean amongst yourself? And then the concerns were listed and they were like, okay, try and do better. And a few weeks after that, there was an increase in the volumes, and then it just tapered off. So it's just a question of continuous engagement.
Okay, cool. I'm very happy. I'm going to skip David so that it does not look like I'm following the sitting sequence. So Ishmael, you've been corporate treasurer, and Ishmael likes to say he's the treasurer of the largest corporate in sub-Saharan Africa. But Ishmael, in your experience, I mean, you have significant, a massive balance sheet. You look at a lot of risks on your balance sheet. And I know you've had discussions around managing those risks using other than our regular day-to-day money market tools. So what has been your experience in engaging the banks and with the products that have been offered?
Okay, good afternoon. Zeal, I don't know whether you are the evangelist. I think in your former banking life, we tried interest rate. We tried interest rate hedge. So, I mean, we were swung with huge borrowings because at that particular point in time, in order to bring in massive infrastructure equipment into the country, we had to open letters of credit and all those kind of things. So both from a working capital and both from a capital expenditure point of view, we ran syndicated note issuance facilities, which was well subscribed. And then we were now sitting with this huge interest rate exposure. So part of the things we did then was we tried to call about 3 to 4 banks who had the skills to structure some transactions. So I think the loan then was either about 140 billion. And then I called Zeal and his cohort and I said, okay guys, let's sit down. Let's even just try and go for just 20% or 30% of the value of the loan and then see how we can structure an interest rate hedge product in place, and then let's try it and hit the market. So we got a few of them, 5 of them into the room, and then we then started the discussion. Halfway, we started reducing the value. Why? Because one, capital cost provision that they need to put in their balance sheet to be able to support the hedge structure was a problem. 2 was, were they going to disclose those hedge products as contingent liabilities? What provisions need to be made? It was, I think, 2-3 months we spent having meetings, and at the end of the day, we had to jettison the idea. Benefit of hindsight, if we've done that by then and followed up subsequently, by now we should be able to have either a telecoms curve that people can actually price against. So today, if you look at your stock market, the most capitalized stock is MTN, over 2.8 trillion naira, and still growing. You know, so access to capital, fantastic idea. But the liabilities that come as a result of either your debt instrument that you're raising and things like that needs to be priced, because from a corporate, all they want is protection of margins. You understand? So if you do your business plan, you come up with some level of anticipation of key performance indicators you give out both to the investing public and co. You then come back and look at your liabilities that will exist. Some of them are financial in nature, some of them are visible, some of them are invisible. Next thing you want to do is how you hedge these instruments or hedge these exposures. It's very clear that at that particular point in time, there was shortage of knowledge and there was no platform for us